What exactly will be the key economic drivers in 2021? Well, Zacks chief equity strategist and economist John Blank is here to outline them for us. Topping your list, John, is the path of the Fed going forward. Now, you've consulted the Fed's dot plot to help shed some light on that. And the Fed just ended their first meeting of the new year this week with a little bit of a change in their subsequent statement from December's statement. So, what's the significance of all of this?
Basically, the Fed has your backs, Terry. I mean, the basic point to learn here, the other point to learn is Yellen was Powell's boss. So there's never been, from now on, from December on, a more tightly wound Fed and Treasury than this one. So number one, the Fed and the Treasury are tied to the hips now. Number two, the dot plot is not going to change for the next 2 years. And if anything is going to change with tapering, what Powell brought to our attention in December is it will be very well communicated well in advance of anybody actually seeing tapering. So the worry that you can use tapering to get out of your stocks is probably too late. You have to wait for Powell to tell you that the tapering can start, and that could tip the market over.
Real estate is on your list. What's the story there?
The story there is that housing, single-family housing, because of COVID, is on fire, and so is the lumber markets that are supplying, single-family housing. For example, 2x4s, benchmark 2x4 price benchmarks are up 130% year on year. So pay attention to what happens to real estate as it pertains to single-family housing on the way out of COVID. In turn, pay attention to commercial and retail real estate on the way out of COVID too. The story may be there's a rotation out of the single-family homes, sell the news that they're up and buy the rumor that there's going to be a revival in commercial and in retail. Obviously, that may never happen in this situation. That's the key conundrum. Does there ever become a recovery in commercial and retail real estate on the back end of COVID? Nobody really knows that, but that's what to pay attention for.
What about other sectors that you look to do well this year?
Well, at the end of the day, you got to buy the tech stocks and the consumer discretionary stocks like last year. My main point to people earlier this year is don't think 2021 is going to be different than 2020. Think it's going to be the same. So pay attention to the ones that worked last year. Outside of that, you might want to look into some of the material stocks because they do have some play to the global economy.
You say trade negotiations with China are going to be making headlines again. Is that going to share the spotlight with the COVID-19 story?
Not in 2021, not until the second half of the year. That would be my simple answer.
What about the virus containment and policy support? Do you expect that to bolster economic growth this year?
Yeah, I'll give a pro tip. I mean, Ron Klain is the new chief of staff for the president, and I've been following him the last week and a half. He does a great job of teeing up what they're doing in policy support. He's very articulate and he's very accurate about what comes out later in the day. So follow Ron Klain and learn about this very idea. He was the Ebola czar back in the day, and now he's the chief of staff, and that's not a surprise. That's the whole point is with the chief of staff with expertise in virus containment and policy support. That's what's going to happen here.
This week, some key U.S. economic indicators came out. Among them, the January Consumer Confidence Index that was up more than expected. The Case-Shiller Index up as well, and that relates to that real estate story that you were talking about. Also due out is the fourth quarter GDP data. So what do these all say about the state of the economy?
Well, first of all, the Q4 GDP data came out this morning, and the basic point is to ignore everything other than the fact that Q4 to Q4 over the last year, GDP is down 3.5%. That correlates with, the unemployment rate being at 3.5% when this thing started. Now it's, 6.7%. So roughly speaking, somewhere between 3.2 and 3.5% is what we lost to the COVID. Now that matters in terms of a $21 trillion economy. That's basically 700 or 800 billion to $1 trillion of lost GDP. So in terms of the stimulus packages, you see that $1.9 trillion stimulus package, but you got to factor that in over multiple years. What you want to be aware of is that's double the size of the loss in GDP. That'll put us over the top of the previous high. Other than that, the rest of this Q4 GDP stuff is a bunch of mishmash of numbers that you're not going to get any value on. The consumer confidence and the Case-Shiller, those are just telling you what you already know, is that people are holed up and buying on the internet, and there's more consumer confidence than you might expect for those of us who have jobs and are keeping at home. And the Case-Shiller is, basically what we've already talked about, Terry, which is single-family repeat sales indexes like Case-Shiller will be going up. We're seeing record prices in most regions of the country because people are buying up single-family homes.
So against that backdrop, the state of the economy here is mixed, would you say?
It's K-shaped. I mean, if you've got yourself in the stock market and you got a remote job, you're doing well, and that things are great. And, in some of the state budgets are turning out quite strong because of that factor. But if you have to go to physical work, it's been a kick in the teeth for you.
We're in the Q4 earnings season, John, as we speak. It got off to a strong start. You wrote recently, by the end of this week, we will have a lot more confidence in our initial positive view of the Q4 earnings season. Now, you and I were on a recent conference call, and I heard you say that Q4 earnings aren't going to be significant to the stock market. Now, do this week's reports change that view?
No, this is typical that analysts underrepresent to CFOs, I should put that the other way. CFOs underrepresent to analysts what their company is going to do so they can outperform during earnings season. So this always happens. Number two, Q4, as we talked about, is a period where December shutdowns happened and it's backward looking. And in a market with this much suppression from stay-at-home orders, learning about what happened in Q4 is basically irrelevant. And again, the Fed has your back. It's the money printing that matters. And that's why you can basically ignore Q4 because fundamentals simply do not matter to this market. Money printing does.
All right, some stocks on your radar now include XPO Logistics, the Mosaic Company, and Newell Brands.
Yeah, let's talk about these three companies. Ticker XPO. This is a third-party logistics provider. It's for time-critical and service-sensitive shipments. So this is not really FedEx or UPS. This is a one-up from that, really sensitive stuff that people want to get around. But it's having the same rise because of the same effect from COVID. Stocks at 115, market cap's 10 billion. This stock's taken a little bit of tumble in the last few days. It'd be kind of an interesting place to put a trade on. Ticker XPO. The other one I like is Mosaic, ticker MOS. This is A for growth in Zacks #1 rank fertilizer stock. Some of the fertilizer stocks are getting a bid because ag prices are way up. And this stock's been doing pretty well on a momentum trade. So take a look at ticker MOS. The third one is Newell Brands, ticker NWL. This is A-rated consumer staples stock with a Zacks #1 rank. Again, nice momentum track. And this guy produces stuff like Marmot, Rubbermaid, Sunbeam, all these different types of commercial products and consumer products that you and I know. There's just a ton of them. So this is your typical consumer play that seems to be working in this environment. So again, XPO Logistics, Mosaic Company, and Newell Brands.
That's the latest from our chief equity strategist and economist, John Blank. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.